to Inside Economics. I'm Mark Zandi, the chief economist of Moody's Analytics, and I'm joined by two of my colleagues, regulars here at Inside Economics, Ryan Sweet. Ryan is speaking, he's of course the head of real-time economics, and you're speaking to us from Avalon, New Jersey, and I can see behind you, it's a beautiful day in Avalon.
Yeah, we've been down here for 2 weeks and the weather's been absolutely perfect. The kids have been on the beach every day.
Yeah, it looks great. How close are you to the beach?
We're right on it.
Fantastic. Yeah,
So
Avalon. That's my favorite part. That and Stone Harbor, right? Do you go down to Stone Harbor at all?
we do.
Yeah,
They have some nice restaurants down there.
yeah. I like. That's my favorite part of it. Although I like Cape May. Have you been down to Cape May? Cape May Point.
We have.
It's nice down there.
It's quieter. I like Cape May because it's very quiet.
Hey, I've got a story for you. So, I have three brothers and a sister. We each have 3 kids, and we go down to Stone Harbor every July 4th. And for years, we participated in a sand making castle contest, and we were big time winners for a number of years. We were well known in Avalon Stone Harbor circles. It's been a few years since we participated. I don't think they had it last year, but because of COVID. But we win by brute force. We no artistic value whatsoever, but we build big castles.
I expect an invitation next year because I want to enter this competition.
Well, you got to be ready for bear if you're going to come with us, man.
But we had volcanoes this week. We had castles that had moats. We weren't messing around.
Oh, really? Okay. Then that sounds like you belong. You can hang. And of course, Chris, Deputy Chief Economist. Chris, are you going to the beach this summer, or what are you up to? Are you Italians? You need a patio. You need your Negroni. You got to look out at Lake whatever.
I got to play bocce.
Yeah, got to do a little bit of that.
That's beach.
Drive around in your Peugeot. No, sorry.
Oh, whoa.
Sorry, I'm sure I got a bunch of Italians very upset. But anyway, so no beach this summer for you guys. For you.
I'm thinking of going to Italy in September.
Oh,
if things clear up.
Good. So. And do you go to the beach when you're in Italy? You do.
If I can, yeah.
Yeah. Such a pretty country. Okay, so we're going to talk about the indicators like we typically. Oh, we have been having guests, except no guests this week. We're flying solo here, without guests. So let's see how this goes. We did the first 3 podcasts without guests, so we're going back to our roots. But we will have. I've got a special guest lined up for the week after July 4th, so we'll go back to that. But for today, it's 3 of us, and we're going to go through some of the indicators like we typically do, and then we're going back to inflation as a big topic. Was that our first podcast or maybe our second podcast? I can't remember. But by popular demand, inflation. The threat of higher inflation is top of mind. Everybody is asking about that, so we thought we'd come back and revisit that and talk about that as our big topic, and then I'll bring it all together at the end. So let's dive right in. And Chris, maybe I'll turn to you first. What's your favorite indicator of the week or of the coming week?
Oh, I've got a good one for this week. Well, the one that shocked me this week. I've been following close, and then I do have some things that are on my list for next week, so I can touch on that too. But the indicator of this week, $900.
$900
on the nose, yeah.
Really, Ryan? Do you have any idea what that would be? $900. That's
prices,
not typical rent. I mean, the typical
lumber prices
rent
would have fallen. Yeah.
What is that?
I've been in a huge decline in lumber prices. Are they down that much?
900. Yep.
Wow.
And so this is the greatest hits podcast, right? Because I think when we covered inflation, I touched on lumber that time too. But $900 is down 47% from the high, which was $1,700 just last month, start of May.
My goodness, I didn't realize it had come down that much. Wow.
See what happens when I go on vacation for 2 weeks? Lumber prices come cratering. But other commodities have come down too.
Yeah, across the board.
Wheat, corn, cotton.
Of course, my favorite, copper.
Copper.
We'll come back to that in a minute. Yeah. So what was it pre-pandemic? What was typical for lumber prices?
450. So we're still
double.
But this is a sharp correction in a couple of weeks. And I think it does point to the fact that prices can adjust and adjust quickly.
Right.
So as we're talking about inflation, important to separate out the short-term and the longer-term effects here.
Right. And what was behind this decline from 1,700 to 900? Anything in particular driving that?
So there are a few theories. Clearly, some of the Fed statements around concerns for inflation, strengthening of the dollar, may have played a role here. But more than that, there's some question or some belief that there's been some speculation certainly going on in the industry, and so some of that supply may be coming back out and causing prices to decline here. There's also been some weakness on the home building side, so builders may be protesting. All right, I'm not gonna pay those dollars. I'll just wait until the prices come back down.
So going back to what you just said, are you saying that there was some hoarding of lumber and speculating that folks could flip the lumber?
Correct.
That's speculation. The idea I can buy it today, hold on it for a little bit, sell it at a higher price to someone who will pay that higher price. And that kind of played out, and people said, oh my gosh, I got to get out of this before I lose my shirt, so to speak.
Yeah, there's speculation on the physical commodity itself, and then on the futures contracts, right? That of course enhances the speculation.
Yeah, sure.
That can occur.
Right. But it's still very high, $900 compared to $450.
It is, but like I said, the correction's been pretty swift.
Pretty swift.
So I would expect more to come here before all is said and done.
Right. Oh, that's a good one. It's a good statistic. And I guess just to round that out, the statistic I've been following and suggesting people follow on a regular basis to gauge all of these inflationary pressures is copper prices. And I think last week we were at $4.50 a pound, which was down from the high, which was probably about a month ago too. I think we're at $4.75 at the peak. I looked today before we started the podcast, we're down to $4.15. So still very high. Anything over $4 per pound is consistent with an economy that's hot and inflationary pressures are high, but definitely coming down, moving down very quickly here. And this feels more like market forces, nothing fundamental, I think, changed. It's just that the speculation in the market's coming off the boil, and that's causing the price to come back down to earth a bit. But I don't think anything fundamental with regard to demand or supply has occurred, except maybe there are reports and some indications that the Chinese economy is starting to slow. Came out of the gates from the pandemic very rapidly, and now it's getting on the other side of that boost to growth from the reopening of the pandemic, and that's taking some demand out of the market, and that may be a fundamental reason why we're starting to see some weakness, but still high, but coming in.
Yeah, and China was also hoarding a lot of commodities, and they've backed off that, so it's causing prices to come down a little bit.
Yeah.
Backing down.
Right.
And wasn't China's stimulus mostly focused on investments rather than transfer payments and things like that? So that
it was
probably contributed to the big run up in commodity prices, because there's a big surge in demand for copper, for example.
Right. In terms of infrastructure.
Correct.
Yeah, exactly.
Building, yeah.
Right. Yeah. Building activity. I think that's part of it. So Ryan, what's your statistic?
All right. So I'm going to have to give you a hint up front.
Okay.
This
darn
led to a big move in the bond market. The number is 13.
Oh, I know what it is. 13 is the number of FOMC members that say the first rate hike is going to be in 2023.
Correct.
I need the hint was a little too much, just a little too much. But I didn't want to
get yelled at again on vacation for picking some odd number.
Yeah, 13 by itself without any whatsoever, that would have been impossible, right? I mean, that would have been.
Yeah, I thought you would see more shift into 2023, and the median would be in 2023. But going from 7 to 13 is a lot. That's a big shift. And then if you look at 2022, you have 7 saying that they expect the first rate hike in 2022. But there's a huge caveat with the dot plot. It's horrible in predicting the timing of the first liftoff. It's terrible in predicting the pace of tightening. And I think a lot of the movement isn't necessarily the core of the FOMC, which is, the Powells, the Brainards, the Claritas of the world, the ones that, really matter for policy. It's the regional Fed presidents that are more hawkish, getting very nervous about, this transitory inflation acceleration.
Yeah, I've always wondered, why are the Fed presidents historically more hawkish than the board governors? Do you know? I mean, why is that the case? Or I've just, or maybe I'm wrong. I mean, that's in my mind's eye. Mm-hmm. I recall that is typically the situation. Is that right?
There are definitely some regional Fed banks that are more historically hawkish, and there's some that are more dovish. So, for example, San Francisco, you have Mary Daly there now. She's more on the dovish side. Yellen was there forever, and she was always very dovish. A lot of regional Fed presidents are tapped from their research departments, and typically the president sets the research agenda. So if they're a hawk, that kind of feeds through into the broader research group.
Yeah. So I think given the change in the dot plots, because of the meeting this past week, they released their forecast and the dot plot forecast. I think they're now consistent with market expectations. So they have.
They're still a little late.
Is that right?
For liftoff. So
for liftoff.
Based on for Eurodollars futures, they have the first rate hike by the end of 2022.
Oh, but how many rate hikes do they have by the end of 23?
2 or 3. So 2 or 3. The tightening's the same. It's the timing.
It's the timing.
For the first. Yep.
Although Bullard, the St. Louis Fed president, was on TV this morning, and he seemed to suggest, in his view, the first rate hike could be late 2022.
Correct. And I mean, Bullard, I would say, going back to the financial crisis, he was very important to watch his comments because he kind of predicted some of the unconventional tools that the Fed was going to adopt. So he kind of led the policy debate. Now, when it comes to tightening cycles, he ebbs and his views are all over the place, which isn't uncharacteristic of regional Fed presidents. You've seen a lot do like complete 180s.
Oh, you're being awfully critical today. Those Fed presidents. It's a tough job they got.
I'm not saying I wouldn't want that job. It's a very, very difficult job. I think it's more. I'm not being critical. I'm frustrated that their communication. Whenever they get a chance to hit a home run on a communication perspective, they kind of come up short.
So, do you think when Bullard gets on TV and makes this statement, is that cleared by the FOMC, the Board of Governors, or is he just out there talking?
I think he's out there just talking.
Interesting.
I mean, there were definitely times. I mean, I remember, if I remember correctly, reading Bernanke's memoir, that he would tell them, like, this is a very important time, let's rein it in. But most of the time, they can go out and say what they want to say.
Right. Bernanke being, of course, the Fed chair.
Right. And I think, based on Bullard's he's not a voting member of the FOMC this year, but he is next year. So I think through the rest of this year and next year, you're going to see a lot more dissents. And dissents are normal. They're going to happen, more frequently. And they're always, at least since 2005, by regional Fed presidents. The last Fed governor to dissent was in 2005.
Is that right? Yeah. Anything else in the FOMC statement or the rest of the forecast that surprised you?
Yeah, the big surprise was the shift in the dot plot, particularly given that their inflation forecast for 2022, 2023 didn't really change that much. It's still, 2.1, 2.2% on the core PC deflator.
So what's your call, Ryan? When do you think they hike first?
Oh, now this is very. I'm really interested in the answer to this question. Let's see if he's, if he's.
Good thing I'm in Avalon. I'm far away. I was thinking late 2023, but I think
repeat that late
2023.
2023. Yeah.
Right, I've been saying that for a while. So the Fed is.
But by the way, that's not
closer.
In our forecast, right? Our forecast is January of 2023.
Correct.
Yeah. Okay.
So to make sure I don't agree with Mark, I'm going to say March of 2023 as of now.
Oh, you've moved it in though. You have come in.
Yeah.
To March of 2023.
Yep.
Yeah.
I just think inflation expectations are, they're right where the Fed wants them to be, but we're not past this transitory period of inflation. And I'm still very comfortable on the other side of this. We're going to see below target inflation for a period of time, but I think the Fed's going to get a little antsy that inflation's perking up too much.
I was thinking maybe we should pull forward our first rate hike into late 2022, and you're saying no, we shouldn't do that.
Yeah, stick with it for now.
Yeah, okay. Chris, what do you what's your view? When do you think the first rate hike is?
I'm getting that bias as well, but I'm not ready to pull the trigger just yet. So I think stick with
the January
2020, yeah, and then let's wait a few months here, see what happens, and we can adjust.
Okay. Well, debate to be continued, I guess. Well, let's see how we all feel after the end of this podcast too, because some minds may change.
Right.
Yeah.
Because it's not just inflation. I mean, the Fed.
Yeah. No, you're right. Yeah.
I mean, the job market, we may not see the unemployment rate come down as quickly as the Fed anticipates, or us, based on the participation rate, could really pick up once schools are reopened and everything like that.
Yeah. We are counting on participation to rise, but you're saying
they may not be, job growth may not be strong.
Quite as strong.
As
we think.
Oh. On that front, though, I don't know. I mean, I look at that, the job opening labor turnover survey, the JOLTS, it's lagged a little bit. It's April, but I think we had record shattering 8.3 million. I'm speaking from my mind's eye, so I may not have it exactly right. 8.3 million open job positions. I mean, just for context, I think the previous all-time high was like 6.4 or something like that.
Wasn't it 9.3?
It was 9.3.
Oh, was it 9.3?
Yeah.
Mm-hmm.
Oh, really? Okay, 9.3 million. Okay, boy, I got that wrong. So that gives you a lot of confidence that there's going to be a lot of job creation here, fill all those open positions. So I don't know.
We'll see.
We'll see. Yeah. Well,
but don't jump the gun. Don't jump.
Okay. Okay. Well, all right. Well, we'll see what I agree with you. I think we'll stick with that and see.
We can mark the podcast exactly what time you said, maybe late 2022, but we'll get there maybe at some point, but not right now.
Right. And the indicator that you have identified for people to follow on an ongoing basis is the 10-year Treasury yield.
Mm-hmm.
And so it had an interesting week, right?
Very interesting week.
You want to describe what happened this week?
So after the FOM statement, post-meeting statement, and the dot plot and the summary of economic projections were released, the 10-year jumped from, I'm going off memory, I think it was 1.48 to above, 1.52, 1.53. Today, it's back down to 1.48. So it's gotten whipsawed, which isn't unusual after you get these big changes in the dot plots and the summary of economic projections. There's that knee-jerk reaction, and then the bond market settles in and digests it and realize the Fed's maybe not as hawkish as their first read was.
Sorry about that, dog. I feel like I would strangle that dog, but he's so
no,
he can't even.
No.
Yeah,
we can't get calls.
That sounds bad. It's highly irritating.
Sounds horrible.
Sorry. I love my dog.
You're gonna get emails from PETA.
Yeah, but he gets kind of lost, and this is his "I'm lost" bark. But hopefully, my wife will rescue him and us. So we're still at 1.5% on the 10-year yield,
but down below it now. I just checked a few minutes ago. We're 1.48.
We're at 144 right now.
What?
It came down even lower?
Yeah.
Are you sure? Are you looking at it right now? You're saying 144?
CNBC, yep.
So that collapsed at the end of trading. Because I was just looking at it. It was at 1.5. It's 144. Okay.
1443.
Okay, so we've been, we talked about this last week too, but I guess we're going to talk about it again. I mean, what is going on? I mean,
so I digged in. I was intrigued by this. So the other day I looked into it, and we were talking like the fundamental factors, inflation expectations, the expected path of the real Fed funds rate, the term premium. So those are the three components of the 10-year Treasury yield. And then you brought up these technical issues that could, possibly causing these swings. So one that I potentially identified is the Treasury general account at the Fed, right? So that was north of $1 trillion recently. They've drawn that down. So what that means is that they're pulling this cash from the Fed, using that to pay for the stimulus rather than issuing more bills and bonds. So less issuance drives prices higher, yields lower.
That is interesting. Do you remember the dollar amounts you're talking about there? Is it hundreds of billions of dollars they're drawing down?
Yeah, in just the last 10 days, it was 150 billion.
And that's very unusual for them to do that.
Yeah, I mean, this was a rapid drawdown.
Oh, I hadn't heard that as an explanation. That is interesting. That certainly is intuitive. It makes sense. So you think there's this kind of technical flow of funds
correct
factor that's weighing down on the 10-year yield?
Yeah, and it's still above what it was pre-COVID by, I think off the top of my head, I think it's like 3 to 4 billion, 330 to 400 billion dollars. That's another, weight to prevent yields from rising too quickly.
What's 3 to 400 billion dollars?
Their account balance currently versus what it was pre-pandemic.
Oh, so you're saying they could draw that down another 3 to 400 billion and just be back to pre-pandemic levels?
Yep. Just put an asterisk next to those numbers, and they're in the ballpark. I just don't remember exactly off the top of my head.
Yeah, I kind of cursorily did some investigation too, because the theory we threw out last week was strong foreign buying. I'm a German insurance company. I'm getting negative 20 basis points on a 10-year German bond, 1.5% on a 10-year Treasury looks pretty attractive to me, despite the currency risk. But you can't see it in the data. You can't see it in the capital flows data. It doesn't look like demand is any stronger than it was or any weaker than it was. Really, no change. So it's hard to point that as to an explanation. But again, we're forecasting that to steadily rise. We have it closer to 2%. It's now 1.44 today. We have it 2% by the end of the year, 2.5% by the end of 2022, 3% by the end of 23. You wouldn't change that forecast yet?
No.
Yeah.
It might be a little bit high because the path to higher rates is going to go through the term premium. Assuming the Fed is able to keep long-term inflation expectations anchored, it's going to be through the term premium that we get higher rates.
Right.
And we could get that because the term premium, in the work that we've done in the past, sensitive to realized inflation. So we're going to get more going forward, and that should cause the term premium to increase.
And just for the listener, because this is a little bit of jargon, I mean, the 10-year Treasury yield, the 1.5%, the nominal 10-year yield, is equal to the sum of inflation expectations plus the real short-term interest rate, so effectively where you think monetary policy is going, plus the term premium, and that's the compensation that investors should get for buying a long-term bond relative to a short-term instrument or security. And the inflation expectations, they've normalized. They're back to 2.5% or 2.25%. So real short-term interest rates are still negative, which that I don't quite understand either in the context of now the Fed's even saying that they're going to raise rates. But the term premium is firmly negative. So instead of getting compensated as an investor for going out longer term, you're paying for that privilege to go out longer term. It's just very weird, especially in the kind of outlook that I think everyone seems to have. Seems like investors have, just to have a negative term premium like that.
Pre-financial crisis, a negative term premium was, extremely. I don't know if we ever had one, but in the post-quantitative easing world, a negative term premium is the norm because that's how the Fed's QE, buying works. Treasuries, is depressing the term premium, lowering long-term rates.
Right. Yeah, it is a bit perplexing to see that. Okay, so we talked about my go-to indicator, copper prices. We talked about Ryan's go-to indicator, 10-year yields. Chris, your go-to indicator did a weird thing this week too, right? Initial claims for unemployment insurance.
Yeah, it went up. So initial claims came in at 412,000, up from 375,000. So an increase of 37,000. First time in 6 weeks that's happened. So disturbing, right? But it's one data point, so you don't want to overreact. And we still have crazy seasonal factors, and Pennsylvania switched over its unemployment insurance system, so maybe that's contributing to it as well. So, yeah, again, we don't want to read too much into it, but certainly you prefer to see it go down than up.
Yeah, they'll get squirrely over the next couple of weeks.
Yeah,
because the 4th of July, the timing of the 4th of July can really throw off the seasonals and everything.
I read that the increase though was in Pennsylvania and California, 2 states. So that feels more technical than fundamental. It doesn't feel like the increases. It feels like the increase is more measurement issue than it is any kind of weakening in the labor market. That doesn't. It's not consistent with anything. Yeah.
Yeah. And I think one thing, whenever the jobless claims numbers come out, I always look at the state level detail and kind of look at like the breadth of increase or decreases, and that gives you. And to your point, in 2 states, it doesn't raise a red flag.
Yeah. Right. And just for context for everybody, a good reading that would be consistent with a rip-roaring economy of full employment would be what?
So I still say 250,000.
250? Okay.
Based on some, I went back this week to do some analysis.
You think it's
I'm
250?
still there. I think it's 250. We were below that before the pandemic, but I think we were, below full employment.
Overshot.
So, yeah. Overshot. Yeah.
Before I move on to the inflation, the big topic, any other statistics, anything else you want to call out? No?
So for next week, existing home sales, new home sales coming out.
That'll be interesting.
That'll be interesting. My expectation, I'll throw it out here, is I think we'll be lighter than consensus.
How about a number?
You want a number? I did jot down a number. 5.6 million on the existing, and consensus probably go 8.6 on the new.
860,000.
860,000. That's right.
Yeah, and you're light because of supply issues or demand issues?
Mostly supply, but also I suspect that demand is weakening as well.
Right, supply because it's hard to build, and the cost of construction, and I don't want to build a home with these lumber prices. I can't find labor temporarily. Right. Demand, these prices are very high. It just doesn't work.
That's right. I lost my last 7 bids for a house. I'm giving up.
I have to tell you, so like I've been looking at homes in Park City, Utah, right? I love Park City, Utah. It's really easy to get to from Philly. You just get on a plane, you go to Salt Lake, you take a 45-minute drive up, and you're in a whole different world. Although I don't know, I was looking at the temperatures there. Even the heat there looks pretty brutal. It was like 107 degrees in Salt Lake today or something. Anyway, so now I went there with about, another 50,000 Californians when the work from anywhere was at its fever pitch. Said, this is crazy, but I keep looking. And so I'm following the same homes over time, the pricing, I'm just following Zillow. And so I was looking at one home, and it was going for about a 1.25 million back in January. It's now going for almost 2 million today. I mean, it hasn't sold, but they're selling. That's just crazy. That's just nuts. It's crazy. Anyway,
for fun, go on Zillow and look at Avalon home prices in just the last year.
Oh, really? I can imagine. Like that home you're in right now, I bet. Gone stretch.
It's unbelievable what the prices have done.
Yeah.
Okay, let's take into account the climate risk. Right?
They're not taking into account the climate
right.
risk. Yeah. They get the 427 scores. Take a look.
I played golf yesterday, and it's off the island. Like you have to go across, and the homes back there they're significantly more affordable, but they're on the bay and everything. And I told Katie, I was like, maybe down the road we should consider investing, because eventually this will be beachfront.
That's right.
Well, that's kind of scary. Beachfront, then you're thinking 10 years ahead. You're going to be underwater.
Yeah,
that doesn't work.
Yeah.
That doesn't work. You're a good forecaster. You're going to connect the dots pretty fast.
I'm trying.
Yeah. So
the other thing that came out. And Chris, I think Chris is close on existing, because if you look at pending home sales, that leads existing by 1 to 2 months. That foreshadows a small drop. You got retail this week.
That's right.
We have a webinar next week about the housing market. Are we in a housing bubble? Because that's the other big question that people keep asking. But we're going to tackle that with a webinar. So Chris and I and one of our colleagues, Todd Metcalf. So we'll be doing that, I think Tuesday or Wednesday next week. Okay, let's talk about inflation. Let's talk about it in the context of our first or second podcast when we each put out our outlook for inflation. So let's reprise that, because I may not have it right, but my memory is that Chris gave a forecast. His forecast was kind of right down the middle, very sanguine. Core consumer expenditure deflator inflation, which is the inflation that the Federal Reserve uses to gauge inflationary pressures and set monetary policy, 2 to 2.25, something like that. Yep. And that would be like, right on the tarmac. That's exactly what the Fed wants. A little bit above their 2% target for an extended period, because we've been below 2% for a while. So through the business cycle, the AIT, the average inflation targeting, I want something above that. And
just to clarify, we're talking long-term forecast, right?
Yeah,
2021, we're going to have
Didn't we say 5
this
years?
year we're going to have elevated inflation.
Yeah. We were saying 5, I think, over the 5-year.
Exactly.
5-year period. To abstract from the near-term up and downs, and, but not forever, but, for the next 5 years. Right. And I took the high side. By the way, our baseline, our most likely scenario, our official forecast is exactly that, between 2 and 2.25. But I took the high side, and I said 2.25 to 2.5, I believe. That's correct. Am I wrong about that? No, I got that right. Okay. And then Ryan took the low, 1.75 to 2, which is kind of sort of where we've been for the past more or less 20 years, below target inflation. Let me ask first. Does anybody want to change their forecast? Ryan?
Nope. So I was a little worried. I mean, I was thinking about like the arithmetic of it, and that we're going to get this really strong number this year, but we're going to get payback next year. So we're going to get core inflation running 1.6 next year, because you look at the base effects, they're going to flip on us. Very favorable this year. They're boosting it year-over-year growth. Next year, they'll depress it. So I think I'm still feeling good.
You're still feeling good. Okay.
Mm-hmm.
And, for the listener, this distinction between 1.75 and 2 and 2.25 and 2.5, the low and the high, that is a material difference. That's not, it might sound small, but that's not small. That's a material difference between the two forecasts. Okay.
Well, by U.S. standards, right?
Oh yeah, by
globally, this is nothing, right?
No, by our standards.
Yeah.
And by the way, I'm not changing my forecast either. The baseline sounds fine to me. I wouldn't argue for that to change, but I do think the risks are to higher rates of inflation. Okay, so those are the forecasts. So tell me how you think about inflation and the inflation outlook. What model are you using to come to these forecasts? I mean, how are you thinking about it? And I should say, it feels like we have models for forecasting everything, but it feels like the models we have for inflation, there's just a lot of them. And there's not a consensus. There doesn't appear to be a consensus, or if there is a consensus, it's certainly a weak consensus on what kind of model we should have and use to try to understand how inflation is going to unfold in the future. This is an area where economists seem to be flying more blindly. There's a lot of uncertainty here with regard to how to think about it, inflation. So Ryan, should I go to you first, or should I go to Chris first? Because Chris is the kind of the consensus. Should I ask him how he thinks about it?
Yeah, let him go first.
Let him go first. Okay.
Then we'll go on the other side.
A lot of talking. Yeah. So how do you think about it? So what's your model for thinking about inflation? I was going to say over the next 5 years, but you just lay it out however you think you want to lay it out. Go ahead.
Yeah. So what I would say is inflation is perhaps one of the oldest and one of the hardest problems in all of economics. The smartest people in my class went out to study inflation and came up with models, and there is no consensus as you lay it out, Mark. There's a lot of different theories. They work at different points in the business cycle. You have, Keynesian approaches, more demand pull type of assumptions. You have more monetarist, quantity of money type of approaches. You have more structural or cost push approach, right? So you have a lot of different theories. None of them actually works all the time, right? So when I'm thinking about inflation, I think of more of an ensemble approach, which maybe leads to why I'm kind of in the middle here in terms of the consensus. I'm looking across the different models, across the different estimates, and kind of putting them out, averaging them out in some regard to come up with an expectation of what inflation should look like. The other thing I would say is that there's been a lot of emphasis on expectations, and expectations in theory matter a lot. But if you go out and you ask consumers you survey them, you ask them what they think inflation will be, and then you compare what actually happens, you find an extraordinarily low correlation between the two. So consumers are no better informed of where inflation will be over a longer horizon than anyone else. Investors as well. Oddly enough, you look at the 5-year forwards, for example, so people who are professionally tracking inflation, paid to understand inflation, you look at their accuracy in terms of how well the 5-year forward rates predict inflation. There too, you see very low correlations, in some cases even negative correlations, right? So my point is that I don't think there is a single theory we can point to, and because of that, then I think we have to take a broad view. We also have to be a little bit humble, because
you hear that, Ryan? Yeah,
I'm the most humble person ever.
The one key takeaway that continues resonating in my mind from my macro class back in grad school is that the best model of inflation is actually a naive model, right? If you want to know next year's inflation, your best estimate over time is to look at what inflation was last year, and that's going to beat out 9 times out of 10. That actually beats out.
I don't know, Ryan. I don't know. I'm listening to what Chris is saying. It feels pretty unsatisfying to me. Yeah. I look at everything and then I put it together in a little pan and I mix it up and I put my finger up in the air and I look at the entrails of the squirrel down the street and and then I tell you, here's my inflation forecast.
Right. When you do it that way, it opens up he can cherry pick. Yeah, what fits his. This is what I think is going to happen. So this is the model I'm running with.
Well, okay, all right.
No.
What you say is not unfair. It's I get it. I respect it. But give me. You must have a way of thinking about things that you think right now fit the stars better and that are giving you a better sense of where inflation is headed right now. It can't be monetarist theory, right? I mean. You're not. No. Are you looking at money supply? You're going, oh my gosh, we're doomed. we're going Weimar Germany. So that can't be. That may be in your pot of models that you look at, but that can't be a big ingredient. So which model would you put the most weight on at this point in time?
So at this point in time, I think the demand pull is certainly what we're seeing here. You have lots of demand after the pandemic, outstripping the supply of goods, and that is causing prices in the short term certainly to increase here. So I would lean on that for the short term. The other factor here, and I think it's an important one, is just the role of the Fed in all of this and how that to my mind trumps everything. They really have all the levers, or many of the levers, at their disposal to control inflation. So from that standpoint, they can pull different policies to get inflation close to where they want it to be. Now, that's not completely true, and certainly last decade shows that they don't have all the control, but they've got a lot of power and they have a lot of history to fall back on. So they can manipulate, or they can certainly adjust the market.
Well, I think
in that regard,
that's an interesting point, but also a little unsatisfying. The Fed can solve all problems, because you're not saying, I think we're going to get 2 to 2.25% inflation because the Fed will drive the economy into recession, so that if we get above 3.5% in the next couple of years, we're going to get 1.5% in the last couple of years of the forecast, and on average, we're going to get 2 and 2.25%. That's not what you're saying.
Correct.
Right.
That's right.
So you're saying the Fed can calibrate just enough to make sure that the economy continues to grow, recovery, the expansion continues, but we still kind of land in that 2 to 2.25% range, typically, and that we're not really going to get outside that band to a significant degree. There might be a quarter or 2 or 3 where you get above or below, but it's not for very long.
Correct. And they have not only the actual rates, tools at their disposal in terms of rates and quantitative easing, but they also have the communication, right, which we alluded to earlier, and that certainly can help to fine tune or anchor the expectations going forward, and that can help to fine tune the inflation outlook in my mind. And that becomes a self-fulfilling reality.
One thing on the Fed that kind of just bugs me a little bit. I mean, if long-term rates stay low, they're kind of pinned down at 1.5%. Does the Fed still have the same ability to engineer things? I mean, I guess they could, without pushing the economy into recession. I mean, they need some help from the bond market, don't they? I mean, long-term rates have to rise at some point for them to get that transmission working in a way that you soft land in the economy in the way that you just described. So that's you do expect long-term, you got to expect long-term rates to start moving up here too.
Yeah. I do. And they don't have complete control.
Yeah,
certainly. So.
Right. Okay.
Don't you think when they begin tapering next year, that should put some upward pressure on long-term rates?
I don't know, but do you believe in the stock or flow for QE? I mean, you're if it's the stock, if it's the amount of securities they have on the balance sheet already, which is now about a third of GDP, right? It's about 35% of GDP. Mm-hmm. That doesn't change very much if they just start tapering QE. I mean, that's pretty much on the margin. You're kind of arguing there's a flow element to this that they're buying.
I was bought into the stock argument, but I'm wondering if the communication aspect of it, because we saw that around the taper tantrum, and even when they started tapering before, long-term rates were able to move a little bit higher.
Right. Yeah, maybe. Yeah,
I don't know.
Yeah. All right. So Ryan, same question to you. What's your model or models, or how are you thinking about your what's the way you're thinking about the inflation outlook?
No, I agree with Chris that you got to look at the demand pull, cost push aspect of it. But when I got to forecast this, there's 2 different horizons. Like my longer term forecast is driven based on forecasting core consumer services prices, which are much more dependent on the U.S. domestic economy, so the labor market, so the unemployment gap, disposable income, things like that. That drives core services prices. And then the other part of the equation is core goods prices, and that's driven more by international factors. So the trade-weighted dollar, Chinese producer prices, those are all things that really influence core goods prices in the U.S. So I kind of like separate them out, and then we can use our macro model to simulate the different paths.
So core services. So you're saying that's labor costs, and
correct.
But that feels like that could be a problem, right? I mean, wage growth is held up very well during the pandemic, and as the labor market continues to tighten, and it feels like it's going to tighten quite considerably,
right?
That wage growth will accelerate and labor costs will rise, or are you also arguing that productivity growth is going to rise as well?
Yeah, I think productivity growth picks up, but I think the type of inflation that we're going to get is going to switch, kind of similar to what we saw after, late in the last expansion when we were, or for most of the last expansion, most of the inflation was coming from core services prices, where we were importing and a lot of disinflation. So core goods prices were very, very weak. So I think that dynamic is something that is, it took the pandemic to kind of temporarily change that, but I think we go back to that, sort of dynamic for the U.S.
Okay, but using your frame, which I think is a reasonable frame. So if I go back pre-pandemic in the last expansion, so this is a period of below 2% inflation, more or less. Mm-hmm. The reason we got there, or the way we got there, was one, goods prices were deflating. We saw actual outright declines, and that was related to a bunch of stuff. And we had weak, or relatively weak, or not strong enough inflation on the service side of the economy, because the labor market was pretty soft up until the very end, and right. Wage growth really didn't accelerate until the very end of that expansion. So are you saying we're going to go back to those kind of conditions in the post-pandemic period, that we're going to get kind of a subpar labor market? We're not back to full employment. We're going to get, and also on the goods side, that we're going to see outright deflation in goods prices. That's not to the
magnitude that we saw. Not to the magnitude that we saw last time. Like goods inflation will remain weak once we get beyond the supply chain disruptions, the past increases in commodity prices, all that, because all that's cost push. So kind of to Chris's point, the one thing I would disagree with is that we have both demand pull and cost push at the same time because of these supply chain disruptions. A lot of demand, with people going out and buying consumer services, that's pulling a lot of these prices higher. But what's sticky is demand pull, and that gets back to the core services prices. So that should be firm for the next couple of years. I think goods prices should be on the softer side.
But I'm still struggling. How do I get to 1 3/4 and 2% inflation growth? That's what we got pre-pandemic. We're going to get. You're saying we're going to get that post-pandemic. We're getting some goods deflation, maybe not as much as we got pre-pandemic, but we're going to get some goods deflation.
Right.
So you've got to be saying that service inflation is going to also be weak. Therefore, and right. Also does that go back to a generally weak labor market?
No, I think the difference now is that we're going to see stronger productivity growth.
Okay. So the way you square that circle is you're going to get, so your wage growth can improve. We're going to have a reasonably tight labor market. Wage growth will improve, but we're going to get pretty good. We're going to get an acceleration in productivity gains, sufficient enough to keep labor costs down.
Yeah, I mean, if you look back at looking at the leading indicators of productivity, they're all pointing towards, much better productivity growth than we saw during the last expansion.
Okay, so this is good. I mean, it's not bad. That would be pretty good, right? I mean, it's not the greatest thing in the world. You still want a little bit higher inflation, but if you're getting low inflation because of high productivity growth, that's not necessarily such a bad thing, right? I mean,
no, of course not.
Although it does feel like the benefits of that may not largely accrue to not workers, but to their employers.
Right.
Okay. All right.
And the other way you like to think about it, like more near term, is I go bottom up. So like, price by price. That's how I do like the monthly forecast out, right. 1 month out to 3 months, you kind of look, bottom up, because you can see, a lot of the drivers for individual prices. One thing I'm having a hard time wrapping my hand around is what's going to happen with rental prices.
Yeah. Right. So, and that doesn't fit your paradigm either.
No, it doesn't. That's what makes me a little bit nervous.
So explain that to the listener. I mean, what's going on with the rents and with the CPI for housing?
Wait, did we clarify? Is our forecast for inflation based off the core CPI or the core PCE deflator?
We said core PCE.
It was core PCE.
Oh, okay. No, all right. I'm less concerned because the rents matter less for core PCE than it does.
Yeah, that's true. But nonetheless, I think this is a really interesting point. So you have said a lot that no one understands, except for me and Chris. So explain, or I can explain it. I can explain it too. But go ahead and explain what we're talking about.
With regards to rents.
Yeah, I mean, core PCE versus core CPI, rents going, and what it mean. What are we worried about in the future? All those kinds of things.
Well, I'm actually curious. and I'll throw my 2 cents in, but I want to hear what you and Chris think about rents. But the difference between the core PCE deflator and the core CPI, the Fed, their preferred measure of inflation is the core PCE deflator. And one of the primary reasons why is that the weights, so how much importance each price within the PCE deflator, core PCE deflator, is given, it changes from month to month based on consumption patterns. Whereas in the CPI, they're fixed for 2 years. So in other words, the CPI assumes that, consumers don't respond to relative price changes, which we know is not correct.
Right. Okay. So the core consumer price index has a very large weight on the cost of housing services,
Correct.
both for rent and for home ownership. In fact, I
PCE.
think in the total CPI, is about a quarter of the CPI is actually housing, I believe, something like that.
Might be a little bit more, right?
Might be
And
a
then
little more, yeah.
yeah, the PCE deflator is more weighted towards healthcare.
Right, because that is the core CPI. The CPI is out of pocket, and a lot of our medical care spending is done through health insurance. It's not out of pocket,
Mm-hmm.
but the core PCE captures
total
spending patterns. Total. It doesn't matter, who pays, how it's paid for.
Correct.
So, and what's happened is that in the pandemic, rents have been very weak, because of the work from anywhere. People have left apartment buildings in the big cities and gone to suburbs, extra smaller cities, and that's hurt rents. And those rents are used for calculating both the rent of shelter and the home ownership in the price indices. And so right now, and it's lagged, right? Because those are based on leases that are long. It could be a year, or in some cases longer than that. But right now, rents are very weak, and that's keeping inflation down, overall inflation, particularly the CPI inflation rate down. But, it does feel like, given the very tight housing market, affordable housing shortage, and people coming back into the cities, rents are now coming back very strongly, that's going to add to, the cost of housing, and that's going to add to overall inflation, particularly as measured by the CPI compared to the PCE.
What about when the forbearances expire? Wouldn't that be a temporary drag on rents?
No, I don't think so. I mean, first of all, that's waning as a factor.
Mm-hmm.
I mean, the number of, by our calculation, my calculation, we have about 4 million renters that are delinquent on their rent. That's down from, 3 times that, maybe 4 times that at the peak. And it's falling pretty quickly, in large part because the economy is improving and all the fiscal support and all the renter assistance, which it's been slow to get out there, but it is getting out there and will get out there. So no, I don't think that's going to have a big impact on the market. I think, maybe briefly, but not for any extended period of time. So I think that's another reason to be a little bit nervous about, inflation going forward, particularly as measured by the CPI. Chris, did I miss anything in my explanation about that, or anything else you wanted to mention about rents?
No, I think you got it.
Okay, all right.
The question is, how long does it take, or
to start flowing through,
and does it moderate quickly, or is this a sustained increase in rents that you're talking about?
Right. Well, it feels like it's going to be pretty sustained because the affordable shortage is persistent. It's actually still growing. I mean, at least by our calculation, the amount of homes that are getting built is still falling well short of the underlying demand for those new homes. And so the vacancy rate across the housing stock is at a 35-year low and is still declining. So feels like, particularly for the affordable part of the market, the lower price points, that we're still going to have a tight rental market for quite some time. Could change with policy, but that'll take time too. Okay, one other component of inflation. And aren't you guys really curious into my model for determining inflation?
I'm worried. Next.
No one asked.
I'm nervous about
I'm just
this
wondering.
I just assumed that was coming.
Okay.
So.
I was waiting for you to say, "Hey, Mark, what's your model for?" But
What's your crazy model for?
What's my crazy model? But the other component is that works in your favor, Ryan, I think, is medical care costs, right?
Mm-hmm. Yes.
So what's going on there?
Well, with all the different fiscal stimulus and rescue packages, a lot of policy has been putting downward pressure on medical costs. They've been capping certain rates and things like that. And at least in the past, policy changes to healthcare are sticky. They don't, change frequently. So that is another reason why, longer term, unless these things are rolled back, core PC deflator is going to be at or a little bit below the Fed's target.
Yeah. So again, medical care costs are more highly weighted in the PCE deflator than in the CPI.
Correct.
This out of pocket distinction I made. And medical care inflation has been very depressed. I actually looked at it. I might have been just looking at medical care services. The rate of inflation year over year is, I think it's the lowest it's ever been. I think if you go back and look, I mean, someone should go back and look to make sure.
Are you looking at the CPI or the PCE?
CPI. I was looking at the CPI for medical care.
Just be careful with the CPI. The response rate for particularly physicians and other medical services, very, very low.
Very low. Right.
And I've reached out to them. They never gave me a good explanation of why the response rate. It's extremely low when you compare across the board. So I don't know how reliable it is.
Might be overstating the case, but there's still a case.
Correct. I think the trend is correct. It's just the magnitude might be off a little bit given the low.
And I think, it looks like Obamacare is here to stay, right? You saw the Supreme Court ruling. That's not going away. So, and that's, I think, the thing that's really depressing medical care inflation is putting real constraints on the healthcare system. And so that may result in very weak medical care inflation for the foreseeable future for the next few years. And that would be more consistent with your view, Ryan.
I can already see you coming towards the dark side.
No, as you can tell, I've already discounted all of that. I'm leading up to my own model of how things work. Hey, one thing I'm going to throw out, and you guys may not know the answer to it, but I just noticed it. In the recent data, the core PCE inflation is higher than the core CPI inflation. I believe I have that right on a year-over-year basis in recent months. Have you observed that? Do I have that right? And do you know why that's going on? I haven't been able to figure that out. It's a real anomaly. It happens, it happens. It's happened 2 or 3 times in history, generally around recessions. So I'm not sure what's going on. Do you guys know? No?
No, I mean, that's an interesting observation. I mean,
maybe you can take a look. I'm really curious.
I will. For context, I think the historical gap between the core PC deflator and the core CPI. So the CPI generally runs, 0.3, 0.4 higher on average than the PC deflator. So when they flip, like you said, around recession, but I'll have to take a look to see.
Yeah, I don't know what's going on. I quickly looked and I just got distracted. So I'd be very curious. I don't think it's anything that's going to last very long, but but I thought it'd be worth taking a look at. Okay, so the way I think about it, and I do think using different models for different situations is appropriate, particularly in terms of horizons. So in the near term, next 6 months, next 12 months, I do think it's about demand and supply. It's, demand is surging coming out of the pandemic, and the supply side of the economy is lagging, having a bit of trouble kind of waking up, for factories to turn on the lights and hotels to, get everything going and people coming back to work, and particularly the pandemic, because the pandemic was highly disruptive to global supply chains, chips and cars and all that kind of stuff, and to the labor market. And it's just taking a bit of time to get the supply side up and running here. So, it's demand and supply, more demand, not enough supply, you get higher prices. And then you get speculation. When people see prices rising for anything, they go, oh, I can make some money here. And they kind of dive right in and try to capitalize on that. And you can particularly see that in markets like the lumber market or, metals markets or, any asset market. And things go parabolic. And then, of course, it's not ultimately the supply side catches up, and it does because businesses can make a boatload of money at these prices. They're making a lot of money. They've got a lot of incentive to figure out the problems to get the factories open and start building more homes. And of course, on the demand side, people respond to that, right? If they have to pay a higher price, they respond, they switch out. So builders build homes with less lumber, or they build fewer homes, or, if the price of oranges are up, people buy apples, that kind of thing. So you see this adjustment go on. And then ultimately the guys who are speculating go, oh my gosh, I got to get out of this trade. Otherwise I'm going to get creamed, and everyone dumps, and, you get this correction back, and, you kind of settle back down to, where you were prior to all of that. And by the way, that dynamic I just described is typical. That's exactly what's happens after, every recession happened after the Great Recession, and every other one. Probably more so this, again, in the pandemic, just because of the idiosyncratic nature of the pandemic. The disruptions are global, and it's been more disruptive, physically more disruptive. So that's the near term. But my model for understanding inflation in the intermediate term, so let's say the 5 years, and that's how I get to the 2.25, 2.5%, is that it goes to kind of the way you think about it, Ryan. I think it's largely determined by the cost of labor, because, if you look at the inflation, 2/3 of it is, say about 20% of it is food and energy. Then another maybe 15, 20% of that is, I'm making this up, so I might not have it exactly right, but 15 to 20% of that is other types of commodities, goods, stuff that we buy, retail stuff. And then the rest of it is services. And that's really dependent on the cost of labor. And that goes to, wage growth relative to underlying productivity growth. And I think a necessary condition for inflation to accelerate is an acceleration in labor costs. It's not sufficient, but I think that it is a necessary condition. And in my view, the labor market and the wage dynamics and the cost increases we're going to see on the labor side, on the other side of the pandemic, are going to be very much like what we saw at the very end of the last expansion in 2018, 19, going into the pandemic. We are going right back to that very tight labor market. It's going to take us another year or year and a half to get there by late 2022, early 23, but we're going there, because with 9.3 million open job positions, we're going to create a boatload of jobs, and this labor market is going to start tightening very rapidly. So I do expect, and by the way, wage growth has held up really well during the pandemic. And so as the labor market tightens, I expect wage growth to accelerate. I expect productivity growth to improve, but I don't expect it to keep up. That's a wild card. Who knows? I could be wrong. That's another thing we should be humble about, but I don't think I'd count on that for a baseline forecast. I'd say that's an upside risk to the forecast, but I think labor costs are going to accelerate. And then a necessary and sufficient condition for inflationary pressures to develop is inflation expectations. I think they do matter. I don't think anyone, to Chris's point, gets it right. They can't predict it, but it's directional. I mean, if they're well anchored, that means they're not moving. That's one thing. But if they're starting to drift higher, that's a totally different ball game. That's when you get into higher labor costs, cause businesses to raise prices. Those higher prices cause workers to demand higher wages, and you get into a kind of a self-reinforcing, because everyone expects that it'll all work out because prices are headed higher. Inflation is accelerating. So I do think if inflation starts to move higher, then we're going into a higher, we're going to a different place with regard to inflation, and inflation expectations are moving up. Now, I don't want to read too much into what's going on now, because a lot of it is, it's dependent on what's going on right now, gasoline prices and, so forth and so on. But I sense that, inflation expectations are starting to move higher here. And to some degree, that's what the Fed wants. And the Fed's going to get it. And the question is, can they control it? Now, so I think that's how you get to 2.25%, 2.5%. I don't think you go much above that, because I agree with Chris. I mean, I think at the end of the day, the Fed knows everything I just said and then some, and is going to has a cookbook. They've been down this path. It's well trodden. They know what they're doing. They've done it before. they'll just tighten down and slow things up, and we'll get an economy that may be a little bit weaker than anyone's anticipating because of the higher rates, but they'll keep the inflation rate from getting in a meaningful way above 2.5%. So that is kind of sort of how I think about. So what do you think? Convinced? Did you change your forecast?
No.
Okay.
No, I think we think about it, all three of us, like similarly, but we're just coming out to a little bit different. And I think it's important, like if I'm right on the low end of 1.75, if you're right at the top end of 2, what'd you say, 2.25?
2.5. At the top.
2.5.
Yep.
It's, I mean, for the US, that's a big difference, but have you guys been getting client questions about stagflation, hyperinflation? I've been getting a lot.
Yep.
So that none of our forecasts are anywhere consistent with either stagflation, which is high unemployment, high inflation, which is a central bank's nightmare, or hyperinflation. Like the hyperinflation is not coming to the US.
You need a supply shock for that. You need some, you need, like back in the day, this real stagflation in the 70s and 80s was oil price shock, right? Because that higher prices creamed the economy, but it added to inflation and inflation expectations. That's stagflation. I mean, you could, but it's hard to envisage what that would be that would do that.
Or does currency shocks affect, like Venezuela? Was that a currency crisis? Did that cause hyperinflation?
Oh, here in the United States?
No, not in the U.S. I'm saying elsewhere.
Emerging markets. Yeah. No, that's
a
big deal because they're open economies, right? And
right.
Currencies move big time.
But things that drive hyperinflation abroad aren't coming here.
Yeah. All right. Okay. Well, anything else on the inflation front we want to bring up? I can't believe it. I've just looked at the clock. We've been chatting for an hour. Is that possible? Can that possibly be?
Yeah. So bottom line,
you guys, but I have a lot of fun doing these. I really enjoy this. Yeah.
I look forward to it every week.
Yeah. Really?
Ryan's doing it on vacation. I'm recovering from a cold.
You should have seen me packing up.
We're here.
I told you guys we had to pack both cars to come down to the shore, and so I drove one, and Katie's like, "Is that a microphone in the front seat?" I'm like, "Oh yeah." I was like, "I am not missing this podcast."
Yeah, exactly.
So Ryan's expecting the robots to take over, and Mark, you're not. I guess that's that's my conclusion here.
I think they're going to be a helping hand. I don't think they take over. Yeah, I expect higher rates of productivity growth, but I don't expect them to be enough to.
Well, that explains the differences in your views, then. Right?
Yeah. What's that?
That explains the differences in your views, right?
Yeah. I guess so.
If it's productivity is the real. Yeah. That's the real differentiator, I think.
Yeah. I don't know. I don't have much to say to wrap all this up. I think we wrapped it up nicely. I mean, I may have actually said the same thing in the first or second podcast when we talked about inflation, and you said it too, Chris. I think we got to be humble here, right? Because inflation is a bear to model and to predict and forecast. We do a lot of forecasting, a lot of modeling, and modeling inflation is really tough. Hey, you want to guess? You'll never guess this, but the other thing that's really hard to forecast, and it's real housing related. When I say tough, it's impossible to forecast.
10-year Treasury yield?
What is it? Mortgage
rates and 10-year Treasury yield.
Yeah, that is. Yeah, anything interest rate related. But I was thinking home ownership. The home ownership rate is like, it's just like, I defy you to model that. Very, very difficult to look at that.
Well, it depends on your horizon, right? It's pretty slow moving. Right?
That's true.
I could tell you next quarter what it'll be.
Oh, yeah. I'm saying over the next 5 to 10 years.
Sure.
Anyway,
I thought you were going to say oil prices.
Yeah. Well, now that I think about it, everything's tough to forecast. To forecast well, to get right. So I do think we need to be humble about this. But the thing I think listeners should come away with, though, and here I would disagree with Ryan. I do think, well, no, maybe I should put it better this way. This is a better way to say it. Not that I disagree with Ryan, is that the most likely scenario is the 2 and 2.25% that Chris is articulating, but the risks are definitively to higher rates of inflation. That the probability distribution is skewed towards higher inflation, not lower inflation. So maybe I do disagree with you, right?
Sounds like it.
Sounds like I do.
Sounds like you're doubling down.
Yeah.
Okay. We bet $1 in the previous podcast. We're now betting $2. $2 on this. $2 on this. Ben, you're going to be the arbiter of all this. Anyway, we're going to call this a podcast. It's been very good discussion, and hopefully you enjoyed it, learned something from it, and we'll talk to you next week.